Welcome to Griffonomics.
Glad to be diving into this one today.
Yeah, we have a really fascinating deep dive lined up for you. So imagine sitting down with a software CEO and telling them that artificial intelligence is about to completely obliterate, 50% of their human user base.
Right, which is basically the nightmare scenario for SaaS companies.
Exactly. But instead of panicking, they look at you and say, great, our revenue is about to quadruple.
It sounds kind of insane when you say it out loud.
It really does. But today, we are bringing you a granular investigative report into how that exact scenario is playing out at one of the biggest software companies in the world, which is Salesforce.
Yeah, they're completely defying what the market has been terrified of lately, right?
Yeah.
That whole SaaSpocalypse narrative.
Right, the SaaSpocalypse.
Which, it's a dramatic term, sure, but the anxiety driving it is very real. Over the last couple of years, there's been this looming fear that if autonomous AI agents can do the work of a sales rep or a customer service agent, you simply don't need to buy traditional software licenses for human employees anymore.
You just don't need the seats.
Exactly. The whole SaaS business model was supposed to just collapse under the weight of AI efficiency.
But Salesforce is flipping that narrative entirely. They are transitioning their entire business model from selling software seats into what they are calling an AI-powered agentic enterprise.
Agentic enterprise, yeah.
And to really get to the bottom of how they are pulling off this pivot, we have combed through a massive stack of sources for this deep dive. I'm talking earnings call transcripts, investor day slides, SEC 10K filings.
The 10Ks are where the real details are.
Oh, absolutely. Plus, breaking financial news reports. We are going to break down the mechanics of their new business model, the historic financial engineering they're executing, and how they are aggressively displacing legacy incumbents.
And we really need that level of granularity to understand the actual mechanics of this shift. Because, they aren't just slapping a chatbot onto their dashboard.
No, not at all. So if you are evaluating enterprise software for your own company, or, if you're just trying to understand how AI is actually monetized beyond all the hype, this deep dive is going to give you the exact blueprint.
We are looking at how digital labor is fundamentally reshaping corporate balance sheets.
Digital labor, let's start right there, because to understand the staggering financial numbers we are going to get into, we first have to understand what Salesforce is actually selling now.
Right, the product shift.
Yeah.
It all revolves around what they call Agentforce 360.
Okay, break that down for us.
So Salesforce is deploying autonomous AI agents across sales, service, marketing, and commerce. And these agents, they don't just draft emails or summarize text. They actively complex multi-step business tasks alongside human workers.
But I want to stop right there and play devil's advocate for a second, because I think a lot of people listening might have the same question. Why does a company need Salesforce to do this?
That is the million-dollar question.
Right, because you look at companies like OpenAI or Anthropic, and they have these incredibly powerful foundational models. Why can't a corporation just buy an enterprise API subscription to one of those models and, build their own autonomous agents?
Well, management at Salesforce answers that by pointing to what they call the last mile mode.
The last mile mode.
Yeah. What's really fascinating here is that raw foundational models, like the ones you just mentioned, they actually fail spectacularly at the enterprise layer on their own.
Really? Why is that?
Because they lack that last mile. And according to the sources, that last mile consists of 4 non-negotiable pillars for a corporation. First, trusted context, which means proprietary data.
Okay.
Second, deterministic execution. Third, having humans in the loop. And fourth, strict governance and compliance.
I was actually thinking about this while reading the investor day slides. It feels like raw large language models are essentially like a brilliant, highly creative intern.
That's a great way to look at it.
Right. This intern has read every book in the library. They know everything about the world, but they don't know your specific company's rules.
You don't know the playbook.
Exactly. They don't know your nuanced return policy. They don't know your compliance guidelines. And they definitely don't know who has the authority to approve a discount. So Salesforce is basically acting as the veteran manager.
Yes.
They are making sure that brilliant intern actually follows the company's strict operating procedures instead of just, guessing and causing a disaster.
That is the perfect analogy. Because if you just let an LLM loose on a customer service ticket, it operates probabilistically.
Meaning it's just guessing the next most likely word.
Right. It guesses the most likely appropriate response. So it might give a full refund to one customer and then literally deny a refund to the exact same type of customer 5 minutes later.
Which is a compliance nightmare.
Exactly. Enterprises cannot survive on probabilistic logic. They've spent the last 20 years codifying their strict business rules into Salesforce workflows. So Agentforce taps directly into that existing deterministic logic.
Okay, but how does the veteran manager actually stop the intern from making a $1 million mistake? We all know LLMs hallucinate, right?
Oh, constantly.
So if Salesforce is letting these agents act autonomously, how does the technology mechanically prevent the AI from just making up a policy on the spot?
This is where we have to look at their innovation engine, specifically something called Agentforce script.
Agentforce script. I saw that term in the 10K.
Yeah, it's the core technology that prevents hallucinations through a process they call hybrid reasoning.
Break down the actual mechanics of that for us. How does hybrid reasoning work?
It's a really fascinating engineering solution. So, as we just discussed, an LLM operates on probabilistic reasoning. Great for conversing naturally with a customer, but terrible for processing a healthcare claim.
Right, you don't want the AI guessing on a healthcare claim.
Exactly. So what Agentforce script does is it physically separates the conversation from the action.
Oh, interesting.
It allows the LLM to use probabilistic reasoning to understand what the user wants. But the millisecond the agent actually needs to take an action like issuing a refund or updating a database,
Yeah.
the system forces the AI onto a deterministic track.
So it basically rips the steering wheel out of the LLM's hands.
Precisely. It locks the agent into rigid if this, then that business logic. The AI cannot hallucinate a refund amount because the deterministic guardrails physically restrict its options to the pre-approved workflows.
That makes a lot of sense. But to make those pre-approved workflows function correctly, the AI needs context, right? It needs data, and not just the data sitting inside Salesforce.
Which brings us to Data Cloud, and specifically Data 360.
The nervous system of the operation.
Exactly. Data 360 uses a technology called zero-copy federation.
Yeah, zero-copy federation. Okay, unpack that.
It allows Salesforce to read vast amounts of structured and unstructured data like PDFs, call transcripts, inventory logs, from external data lakes like Snowflake or Databricks.
Okay.
But the critical innovation here is that it does this without ever having to physically move or copy the data into Salesforce.
Wait, I need to push back on the mechanics of that. If the AI isn't ingesting or moving the data from Databricks, how is it actually reading it to solve a complex workflow?
Right.
And more importantly, how on earth is that secure? Letting an autonomous agent rummage through external corporate data lakes sounds like a massive compliance vulnerability.
It is exactly what every CIO asks when they see the pitch. The mechanism of zero-copy federation works by reading the metadata and creating a virtualization layer.
A virtualization layer.
Yeah. It essentially points to the data where it lives in Snowflake, sends the specific query, and only pulls back the exact answer needed for the immediate task.
Ah, I see.
And once the task is complete, that connection drops. There is no massive duplication of sensitive data, which completely eliminates the risk of stale or unsynced records.
Okay, so the data stays at rest in its original fortress.
Exactly. And regarding your security question, this all operates underneath what Salesforce calls the Einstein trust layer.
The trust layer.
Right. If we go back to your brilliant intern analogy, the trust layer is the veteran manager physically checking the intern's badge access before every single task.
Oh, wow.
Because of those deterministic guardrails, the AI agent is strictly governed by the existing permissions in the Salesforce org. The agent only sees the exact data that the human user who triggered it is explicitly permitted to see.
So it can't accidentally access the CEO's payroll data?
Exactly. It actively masks personally identifiable information, it prevents corporate data from being stored in external LLMs, and it maintains a completely immutable audit trail.
So we have established the architecture here. You've built this secure, hallucination-free digital worker that respects your company's data silos. But now we have to talk about monetization, which is where this deep dive gets into the massive financial implications.
The fun part.
Exactly. Because if you build an AI that successfully does the work of 5 human employees, and you fire those 5 humans, don't you lose 5 software seat licenses? How is this not cannibalizing their own revenue?
This is the strategic inflection point that Wall Street was initially terrified of, and it's where Salesforce is proving them wrong. Currently, about 95% of Salesforce's revenue is still subscription-based.
Okay.
But to survive this apocalypse, they are rolling out an entirely new revenue infrastructure.
And the sources outline two new models here, right? Flex credits and AELAs.
Yes, so flex credits are a consumption-based model. You pay for the compute and the actions the AI uses, which gives customers a lot of flexibility to scale up and down.
Makes sense.
But the real game changer, the mechanism that is completely transforming their balance sheet, are the AELAs.
Which stands for Agentic Enterprise License Agreements.
Exactly. These are massive, flat-fee, multi-year contracts for wall-to-wall digital labor.
And here is where we need to linger on the math, because this is the staggering revelation from the earnings transcripts.
It really is.
You'd logically assume that trading human software seats for AI would shrink their revenue. But when customers upgrade from traditional licenses to these AELAs, Salesforce is seeing a 3x to 4x ARR multiplier.
Yes, a 3x to 4x annual recurring revenue multiplier.
They are multiplying their revenue by up to 4 times. How does the math on that actually work? If a company fires 5 customer service reps, how does Salesforce make more money?
It comes down to value-based pricing and capturing the budget that used to go to human payroll. Think about it from the customer's perspective.
Okay.
If a company replaces 5 human workers who each cost, say, $60,000 a year in salary, they're receiving $300,000 in operational costs.
Right.
Under the old model, Salesforce might have charged $1,000 a year for those 5 human software seats. Under the new AELA model, Salesforce says, we will provide the digital labor to do the work of those 5 humans, and we will charge you $4,000. The customer is thrilled because they just saved hundreds of thousands in payroll. And Salesforce is thrilled because their software revenue just 4x'd. They are effectively trading a low-margin software seat for a high-margin digital labor contract.
That completely redefines the economics of enterprise software.
It really does.
And to measure the value of that digital labor, they actually had to invent a new metric, right? Because the broader tech industry has been obsessed with counting raw AI tokens.
Right, but tokens are meaningless to a business leader.
Oh, okay.
Tokens are a measure of compute, not a measure of productivity. If we connect this to the bigger picture, a CEO does not want to pay for raw compute power or API calls. They want to pay for an outcome.
Right, they want results.
So Salesforce shifted the conversation entirely by introducing Agentic Work Units, or AWUs.
DWs.
An AWU measures an actual business task that has been successfully completed end-to-end. We are talking about a customer service case fully resolved without human intervention, or a sales lead automatically qualified, enriched, and logged.
And the volume they are pushing is insane. The Q4 numbers showed 771 million AWUs were completed in a single quarter.
771 million, just in Q4.
If you are a CIO listening to this, this fundamentally changes how you negotiate with software vendors. You are no longer haggling over how many user logins your team needs. You are negotiating the piece rate of digital labor.
Exactly. And the financial leading indicator tied to this shift is incredibly bullish. It's a metric called net new AOV, or annual order value.
Okay, what does that measure?
It measures their new bookings minus customer attrition. Management noted in the transcripts that this metric has officially crossed into positive territory, outpacing overall AOV growth.
Which is a big deal.
It's massive.
Yeah.
In software economics, when that specific crossover happens, it is the ultimate leading indicator. It signals that organic revenue growth is going to reaccelerate.
And based on these AWU volumes, they are projecting that reacceleration to hit forcefully in the second half of fiscal year 2027. But let's follow the money here. If enterprise IT budgets are generally flat, and customers are suddenly spending 3 to 4 times more on Salesforce because of these agentic agreements, well, that budget has to be coming from somewhere else.
Oh, absolutely.
They aren't just printing new money. They must be bleeding other vendors dry.
They absolutely are. They are using this unified agentic advantage to aggressively extract massive companies from legacy systems. They are consolidating the tech stack.
The phrasing in the transcripts from some of these enterprise customers was actually pretty brutal.
Yeah, it was.
They talked about pulling massive pharma giants out of what they called Viva purgatory.
Right. So Viva has long been the dominant legacy software in the life sciences space. But Salesforce launched their life sciences cloud, which natively integrates these new AI agents we've been talking about.
Okay.
And because of the deterministic guardrails, they are successfully migrating highly regulated pharmaceutical companies, we're talking giants like Pfizer, Novartis, and AstraZeneca, over to their platform.
Wow. Just pulling them right out?
Yep. And they're doing the exact same thing in the IT service management space, migrating frustrated customers out of what was referred to in the sources as ServiceNow purgatory.
And it isn't just corporate extraction either. They are hitting the public sector incredibly hard. The sources highlight a massive 10-year, $5.6 billion U.S. Army IDIQ contract for a platform called Missionforce.
Which is really the ultimate validation of their last-mile mode.
Oh, for sure.
If the U.S. Army trusts your autonomous agents to handle their deterministic workflows and read their data silos without hallucinating, that essentially ends the debate about whether this technology is secure enough for the enterprise.
But there is a massive missing link in this strategy that we need to address.
Okay, what's that?
If this entire Agentforce ecosystem relies on perfect data grounding, if Data 360 needs clean, accessible data to feed the hybrid reasoning engine, what happens to companies sitting on decades of messy, disconnected legacy systems?
Right, the bad data problem.
Yeah. How did Salesforce solve that bottleneck to keep fueling this market capture?
That is exactly why they executed a massive piece of strategic M&A. In November of 2025, they acquired Informatica for $9.6 billion.
Informatica.
Yes, Informatica is an enterprise cloud data management platform, and it is the exact missing link you're talking about.
Looking at the mechanics of it, the Informatica acquisition perfectly bridges the gap to the last mile mode. It's essentially a $9.6 billion bridge to connect all of a company's fragmented, messy data directly to these new AI agents.
It solves the dreaded data silo problem, because without clean, cataloged master data management, your AI agents are useless. They will just confidently execute the wrong actions based on bad data.
Right.
Informatica cleans and harmonizes that data so Data 360 can actually use it. And what's incredibly impressive from a capital allocation standpoint is that management accelerated the accretion timeline for this $9.6 billion acquisition to just 1 year.
1 year.
Yeah. It is already generating $1.1 billion in ARR for them.
Okay, so let's look at the balance sheet. Because all of this, the market capture from Viva and ServiceNow, the 3x ARR multiplication, the billions in public sector contracts, it is generating an absurd amount of cash.
An unbelievable amount.
And what Salesforce is doing with that cash right now is quite literally making Wall Street history.
Let's lay out the baseline financial realities for their fiscal year 2026. They hit a record $41.5 billion in total revenue.
Which is up 10% year over year.
Right. And they generated a staggering $15 billion in operating cash flow. And that AI portfolio surge we discussed, Agentforce and Data 360 ARR alone hit $2.9 billion.
Up 200% year over year.
Exactly. And their total backlog, the remaining performance obligation, sits at $72.4 billion, which is driven by a 26% increase in deals over $1 million.
So the underlying business is clearly humming, but the debt forensics of what they're doing next is wild.
It really is.
The board authorized a $50 billion total share repurchase program. And to kick that off, in March 2026, they executed the largest accelerated share repurchase, or ASR, in corporate history at $25 billion.
$25 billion at once.
Yeah. They are retiring approximately 103 million shares immediately.
And an ASR of that size requires massive upfront capital. You essentially hand an investment bank billions of dollars, and they immediately hand you a massive flock of your own shares to retire, settling the rest over time.
But here is the kicker that blew my mind in the SEC filings. To fund this historic buyback without completely draining their operating cash, Salesforce is reportedly planning a record-breaking $25 billion bond sale.
Yes.
I have to push back on the logic of this. Interest rates are not zero anymore. The debt service on $25 billion is massive.
It is.
Why on earth would a highly profitable tech company borrow $25 billion just to buy its own stock? Why not just use that $15 billion in operating cash?
Because their operating cash needs to fund the aggressive R&D required to keep Agentforce ahead of the curve.
Okay.
This move comes down to a masterclass in accretion versus dilution. Management has explicitly stated they view their current valuation as severely dislocated.
Dislocated.
Yeah. They believe the broader market is still fundamentally undervaluing them due to those lingering SaaSpocalypse fears we talked about at the top of the deep dive.
So they view their own equity as mispriced.
Exactly. The cost of that new debt is mathematically lower than what they believe their cost of equity is right now. By issuing bonds, they don't create new shares. They use that borrowed cash to buy back their own stock at what they see as a massive discount.
Wow.
This aggressively shrinks the float and forcefully reverses the past dilution that was caused by their massive stock-funded acquisitions of Slack and Tableau years ago.
It makes total sense when you frame it that way. It's the corporate equivalent of refinancing your house to buy the empty lot next door because you have inside information that the neighborhood is about to boom.
That's a great way to put it.
Right. They are taking on $25 billion in debt because they have such high conviction in this impending agentic growth reacceleration that they'd rather own the equity themselves before Wall Street catches on.
And the strategy is already bearing fruit. Despite the stock-based compensation they issue to employees, their aggressive buybacks actually caused the diluted share count to fall 2% year over year.
So they are successfully shrinking the pie so that every remaining slice is worth exponentially more.
Exactly.
Okay, we have covered massive ground today. We've unpacked the operational shift to digital labor, the mechanics of hybrid reasoning and zero-copy data, the math behind the 3x ARR multiplier, the aggressive competitive displacements, and this historic $25 billion debt-funded share repurchase.
A lot to digest.
Let's bring this all together. What is the final verdict on Salesforce's position right now?
The strategic outlook from our analysis is that Salesforce is a high-conviction re-rating play.
High conviction.
Yes, they are executing a flawless pivot. They are successfully upgrading traditional human software seats into high-margin digital labor contracts.
Right.
They are maintaining a clear trajectory toward their upgraded FY30 revenue target of $63 billion. And through incredibly strict operational discipline and share reduction, they're driving toward the rule of 50.
Which means their revenue growth rate combined with their operating margin will equal or exceed 50%.
Precisely.
It really is a masterclass in pivoting a legacy SaaS business model into the AI era without destroying your own revenue base.
They aren't just surviving the AI disruption. They are architecting the infrastructure for it.
Which leaves us with a pretty profound and maybe slightly terrifying thought to mull over.
Oh.
If Salesforce has proven that agentic work units can successfully and autonomously execute 771 million complex business tasks in a single quarter,
Yeah.
what exactly does the org chart of a Fortune 500 company look like 5 years from now?
That is the big question.
Are we rapidly approaching a reality where the largest employee demographic inside a corporation isn't human at all, but a fleet of rented digital labor?
It fundamentally changes what a company is. We are moving from managing software applications to managing digital workforces, and the economics of that shift are just beginning to materialize.
Risk defined, core
Yeah.
fully protected.